Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing VICI stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. VICI Properties is a REIT specializing in casinos. It was formed as part of the Chapter 11 bankruptcy reorg of Caesars Entertainment. After filing bankruptcy in January 2015, Caesars proposed splitting into two companies, a REIT, which would own the company's casinos, and an operating company, which would manage them. The plan was designed to maximize value for Caesars creditors by taking advantage of favorable tax treatments for REITs. The spin-off of VICI was completed in October 2017, the day that Caesars emerged from bankruptcy. The REIT has 43 properties in 15 states, 3.8 million square feet of casino space, and 58,000 hotel rooms. The company is headquartered in New York City and was founded in 2017. The ticker trades on the New York Stock Exchange and Deutsche Börse. Let's get started with the model. This is a large cap company, 31 billion market cap. They're trading at $32 a share, and they have 963 million shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. Their free cash flow looks really good. It grows from 700 million to over 1 billion. Net income is the profit or loss on the income statement. It's revenue minus expenses. That peaks in 2021 at 1 billion. Revenue is the sales for the company, and that goes up from 900 million to almost 1.6 billion. This is the company's income statement. The top line is the revenue, the sales. Below that is the cost of revenue. These are the expenses directly related to generating the revenue. Revenue minus cost of revenue gives you your gross profit. REITs don't have much in cost of revenue, so it's mostly gross margin. Below that is their operating expenses. These are all the expenses not directly related to generating the revenue. Gross profit minus operating expenses gives you your operating income. And that also looks really good, 1.4 billion in the trailing 12 months. REITs tend to take on a lot of debt. They paid 383 million of interest on their debt. Then you have other income and expenses. These are all the gains or losses not part of the company's core operations. For an example, the gain or loss on the sale of a casino. Then you have your pre-tax income. As you can see, REITs don't pay much in taxes. And then the bottom line of the income statement is your net income, which grew a lot from 550 million to almost 1 billion. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company generates from its operational business. And that increases each year from 680 million to over 1 billion. They only spend 22 million in CapEx in the trailing 12 months. CapEx are investments in property, plant, and equipment. Operating cash flow minus CapEx gives you your free cash flow, and that was over 1 billion in the trailing 12 months. Most of a REIT's free cash flow goes to pay a dividend. So there's very little money left over to grow the business. So REITs tend to add a lot of stock and debt to fund growth. You can see they added 1.2 billion of stock in 2019, then 1.5 billion, 2.4 billion, and 5.6 billion in the trailing 12 months. Every time a company adds common stock, it increases the shares outstanding and makes your shares less valuable. They also add a lot of debt, 2.3 billion, 2.6 billion. They did pay down over 2 billion in 2021. They added 600 million in the trailing 12 months. Let's look at their capital structure. 15 billion of equity, 6 billion of debt. They're 73% equity, 27% debt. And I gave them the middle whack on Finbox, 7.8%, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's 40 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $36 billion. We divide that by 963 million shares. And we get a calculated stock price of $37. They're trading at $32, so they're trading at a 13% discount. It's a buy according to the model. Their revenue target for 2024 is 3 billion. For 2023, it's 2.9 billion. And for 2022, it's 2.4 billion. And I continue this growth into 2025, and I got 3.1 billion. That's how I got their future revenue estimates. They convert on average 66% of their revenue into free cash flow, so I multiplied their future revenue estimates by 66%. That's how I got their future free cash flows. Simply Wall Street is really high on this one. Their valuation is $85. They're saying it's 62% undervalued. 7 analysts priced this stock, and the average price target is 37, the lowest 32, the highest 46. This is where the stock has been trading the last 5 years. Right before COVID, it was about $28. Then it dropped to about $13. Then the stock ran up past its pre-COVID levels. It's declined a little bit. Now it's getting pretty close to its all-time highs. The reason people buy REITs is for the high dividend payment. They raise their dividend from 26 cents to 36 cents, and they pay a quarterly dividend. The yield is about 4.5%, but you usually get taxed at the higher tax rate when you receive dividends from REITs. And their dividend payment is over 100% of their net income and over 100% of their free cash flow. So they need to raise their free cash flow or lower their dividend payment. Their dividend yield has been pretty steady since they started. The forecast is for their yield to grow a little bit to 5% by 2024. Their beta is 1, so the stock moves with the market. It's gone down 5% in the past 52 weeks, while the S&P is up 3%. The 52-week low is 26, the high is 34. And the stock is trading above its 50-day and 200-day moving average. This is a pretty popular stock. 11 million shares are traded each day. Almost all the shares outstanding are on float. 81% are held by institutions and 4% of the shares are shorted. If you invested $10,000 into this company when they started trading, you'd be at $20,000 today. That's a 100% return, a 17% annual return. The CEO's annual salary is $900,000. Their total compensation package is $8 million. In the past 12 months, there's been only insider buying, no selling. Here are the dates, the person, the number of shares, and the price. 81% of the company is held by institutions, 19% by the general public, and only 0.2% by insiders. Their employee count has gone down a little bit from 140 to 129. Here's a list of their top 10 largest shareholders. Capital Research is the largest at 14%. Vanguard, BlackRock, Wellington. Let's look at their financial ratios. They have a PE of 31, that's stock price over earnings per share, price to sales of 20, price to book of 2, and a price to free cash flow of 31. Their return on invested capital is 5%. Their interest coverage ratio is 3.6. Their ROE is 6.5%. They have a high current ratio and quick ratio of 3.9. In the trailing 12 months, they generated over $1 billion of free cash flow. They have $2.8 billion of working capital, and they pay out $1.4 billion of dividend payments. So it looks like the company has enough money to get through the next 12 months. The best way to look at ratios is to compare them to companies in the same industry. There are 28 companies in the same industry as VICI, and VICI is the largest in terms of market cap. Their yield is a little lower than average. A lot of these REITs have negative free cash flow. They have a big positive. Usually when you value a REIT, you don't look at price to earnings. Their price to free cash flow is worse than average, but a lot of these companies are NA because they have negative free cash flow. So at least they're positive. They generate more revenue than any company on this list, and they're growing at an amazing rate, a 140% 5-year annual revenue growth rate. So to summarize, I have them trading at a 13% discount, and I think casino stocks are fairly safe. It doesn't matter if the economy is prospering or in a recession, people still like going to casinos. So it seems like a pretty safe dividend stock to invest in. I rank their free cash flows 8 out of 10, their revenue 7 out of 10, and their ratio is 5 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.